welcome to the show this morning, guys. And listen, it's going to be a good show this morning. I'm going to add a little bit of extra toward the end of the show. First, I'm going to do the markets. I'm going to snap right through them real quick. Then I'm going to talk about Canada and how Donald Trump, he says that he's going to make us pay up here. He's going to really hurt us financially because of the statements that that our prime minister said, you know. Anyway, I'm going to get right to it, and first we're going to open up the charts right here. Okay, and the first thing we're going to go to is we're going to go to Bitcoin. Now, here's the thing about Bitcoin. Bitcoin has been suffering lately. We're in a bear market, and it's trying to make... Now, I've been saying for the last few days, well, all these guys, you know, you go back last week and listen to my stories, my news report in the morning, and you'll hear me saying that Bitcoin was going to go down to make new bottoms. And in fact, I thought it was going to make 3 bottoms before it goes back up again. And these guys on there have been telling you Bitcoin's going to go to the moon. Like last week, they're saying it's going to go straight up. It's going to better buy quick because it's going to go straight up. And I was telling you, hold your horses here for a minute. You're going to have buying opportunities coming up. Well, right now, we are kind of in making a bottom, and this is kind of one of your little buying opportunities right in here. But it might go lower on the next bottom. But that's what we're doing right now. We're in the process of making bottoms in Bitcoin. And that's your time to buy, really. The time to buy is when Bitcoin's making bottoms. Don't go buying it when it's in a bull market and it's like going to 18,000, 19,000, 20,000. That's not when to buy Bitcoin. When to buy Bitcoin is when Bitcoin is settled down, it's making bottoms, and it's a bear market like it is right now. Okay, and so that's what we're seeing. We're seeing it making bottoms. Let's go to the 12-hour chart here, and let's pull back. And what you'll see is it made a bottom right here at around 59.27, somewhere around in there. And right now, it's in the process of making another bottom. If we look at the moving averages today, the moving averages have it going down. It's going to continue to make this bottom. And what I'm looking for is a big red candle to solidify this bottom. Now, we didn't really see a bottom in here. We didn't see a big red candle in this area right here. But this one right here had a definite big red candle down. And that's what we're looking for right now, is one big red candle down to make a bottom. Probably the bottom would probably be around 5,500, you know. And then what we're going to look at is we're going to look at a big red candle down to like 5,500. That's what I'm looking for. And then it'll start back up again. And it'll probably go back up to maybe, I don't know. It could go back up to 7,000 or 8,000, you know. Maybe even 9,000 or close to that, 8,800 or something, and then it's going to take another dive and make another bottom, the final bottom. How far out in the future that final bottom is, I don't exactly know. I mean, if you knew that, you could be very rich, okay? But what I'm doing is I'm giving you a clue as to what it's doing, and these guys that are out there saying, oh, Bitcoin to the moon, you better buy it now, and stuff. They was telling you that 2 weeks ago, and it didn't go to the moon, and I was saying it's going to give you buying opportunities, and that's exactly what it's doing, and right now is a buying opportunity, but it might go lower. You might get even better buying opportunities, so it's up to you whether you want to buy on this buying opportunity or risk it. It's just like in Let's Make a Deal. He said, okay, do you want to risk going behind curtain number 1, or do you want what's in the box over here? You know, and so you can risk it right now. You can risk buying in right now and buying some at these little bit higher prices, or you can risk it going lower for another bottom, which it might do or it might not do at this point, because Bitcoin has been a bit in a bear market for a while now, and I mean it could go back up again at this point. It's not this could be the third bottom. We could count this kind of as a bottom here, but maybe not. It might make another bottom past this one. We're in the bottom making process right now, though. This is a process where what it does is it weeds out the weak hands in the marketplace. And that's what's going on right now. This is behaving more or less like one of the last free markets on earth, more or less free markets, Bitcoin. So now let's move on to the silver price. Now, if you remember last week, I said that the silver price was going to go back into I expected it to go back in the 1720 range. Well, right now, it's bid 1715 and ask 1725. So it's right on my target where I said it was going to go. It's right in the middle, smack dab in the middle of the target where I said it was going to go. And I'm right spot on that, where I thought silver was going to go. And so the longer it clings to this price target range between, say, 1710 and 1740, the more likely it's going to stay in this new area, this new zone, rather than go back down into the 1660 or 1650 range. The longer it stays here. So now it's tentatively here. It's made its way up to like 1720. The longer it stays in this range, the more likely it's going to stay in this range for a longer period of time yet. And I expect that it's going to stay in these two ranges until it makes its big move. And its big move is coming up. It's coming up before the end of the year, I believe, personally. Dow Jones today, 62 points up on the day so far. And this market is hanging on because the bond market's hanging on. Right now. And the bond market's hanging on is because we found buyers. The reason why we're finding so many buyers in the bond market is simply there's a profit ratio for the stock market, and there's a profit ratio on the bonds. And you can see exactly what the profit ratio is on the bonds. You know, like the U.S. 10-year right now is at, 2.95, something like that. Well, that's the profit ratio on a U.S. 10-year bond. You take it out for 10 years, that's the profit you make. Now, on the stock market, you have another profit ratio. It's very similar. And they're both in a very similar, but the bonds actually now are just slightly surpassing the stock market. And so what's happening is these traders are, because it's only a few pips, just a few basis points difference between the two. But the bonds are outperforming, and they were really outperforming the stock market when they were up at 3.10. But now that they've settled back down to 2.95, they're close. The stock market and the bonds are close in profit ratio. But that's counting in this bull market that we've had over the years. And now what we've got is in the stock market. It changed right on this peak right here. It changed from a bull market to a bear market. And this stock market is in a bear market, even though it's been going along roughly level ever since back in the February 8th. It's been going along roughly level since February 8th. Still, it's a bear market. This is a bear market. And we were the longest time in a bull market all the way up to this peak. What happened was the Fed came in, and the Fed has changed it from a bull market into a bear market. That's what the Fed's done. And they're going to change it into a crashing market because they're withdrawing liquidity is what's caused it to change from a bull market to a bear market. And that's all the Fed withdrawing liquidity. They're increasing the amount of liquidity that they're drawing from this market, and it's going to change over into a crashing market very, very soon. Now, let's take a look at crude oil. Crude oil is bounced back a little bit. It's up 36 cents on the day. It's up half a percent roughly, just slightly over 0.5% on the day. It's not no real big gain in crude oil, but I think this peak is pretty much going to hold. I don't think it's going to surpass that peak of $72.48 anytime in the real close future. But now looking ahead 2 years into the future, or maybe 3 years into the future, this price is going to be over $200 a barrel for oil. But reflected in dollars, you're not going to be able to count it as $200 anymore because we'll be in the middle of the hyperinflation then. So I can't give you a price tag on what a barrel of oil would be worth. But reflected in today's value, $200 or more. It's reflected in today's value. In other words, if we were to extend what the dollar is worth right now out into the future, it would be $200. It'll be the equivalent of what $200 would be right now. But it might be like $300,000 because the dollar will be in a hyperinflation. $300,000 for a barrel of oil sort of thing or something like crazy like that. because we're going into a hyperinflation by then, by 2 years from now. But the price of oil is going to be exceedingly higher 2 years from now than it is now. Exceedingly higher, and you're not going to want to drive your big SUV or whatever. Cryptocurrency market capitalizations, Bitcoin's back up to 40% dominance, which is really something. Bitcoin has moved up in its dominance just in the last little bit as we've moved into this deeper into this bear market. People are going back more for Bitcoin, evidently. $275 billion in market capital. Some of these coins now are doing a little bit of a bounce back, but Bitcoin itself is not really bouncing back. But some of these altcoins are doing a little bit of a bounce back, but IOTA's not. Litecoin's not. $95.63. That's a good time. That's a good buying opportunity on Litecoin. Solid. That's solid. That's really solid. If you're into these coins, that's looking good. Litecoin is looking good at 95 bucks. You know, bonds and rates today. We're seeing all the bond rates staying roughly. The 10 years staying roughly at around 3% more or less. It's 2.955 on the U.S. 10-year. The yields are down ever so insignificantly, but they are down just ever so slightly. Yields are down today. This means there are buyers in the market today. All the way across the board on the bonds today. Now, at the end of this month, the Fed's going to raise the bar, $10 billion. And this should... bond yields should start to rise again then, after that, after the end of this month. So after the 30th of this month, or after the 31st of this month, when we move into next month, you're going to see these yields start to pop again, just like they were before. So the bonds are going to start crashing again at the end of this month. And this is going to be problems because we're getting up into the problem territory with this. U.S. dollar index today, 94.28. The dollar's up today, and this is all got to do with interest rates going, interest rate 25 basis point interest rate on the federal funds rate going up. That's what this has got to do with, 94.28. Now, what we're going to talk about is the Canadian banks. Now, I'm going to tell you what. Donald Trump, he says that he's going to give Canada a little push. He didn't say that. He didn't say give him a little push, but essentially that's what it amounts to. If he tries to hurt us financially, I'm going to tell you why I think that's not really such a good idea. And one of them down there said that about our Prime Minister, he says he deserves a special place in hell. I think that was a little bit uncalled for, you know. It's going a little bit far, in my opinion. Because that's kind of like judging the man, you know, as going to hell, you know. It's just like ridiculous. But anyway, let's just let that go and forget that they even said that. But what about the Canadian banks here, and how are they tied to the American banks, and what is the underlying problem? Well, I'm going to get to the point what the underlying problem is. What the underlying problem is the Canadian real estate market exploded in value. And exploded like nothing else you've ever seen. It is so out of touch with reality, I'll call it that. A shack in Toronto. When I say a shack, I'm talking not really a shack, a house, but it's like a shitty little house. It's like a house you'd buy for, like in West Virginia, for like $20,000, sort of a house, or even $15,000 if you were to shop around. A house like that in Toronto is $1 million house. Quite seriously. I'm not exaggerating. They're not really all that nice a house. What do you get for $1 million? You're probably living in quite a bit nicer house than you get for $1 million. You're probably living in the $3 million home in Ontario. This is how our real estate market has exploded in price and oversold. Now, you'd say, well, what's the problem with that? You want to know what the problem with that is? Well, I'm going to tell you what the problem is they've assessed the value of the banking system of all of these homes in the Canadian real estate market. right? Now, we're talking millions for shacks. Now, you know how many homes there are in the Toronto region? Well, Toronto's got like 3 million people. Now, you can imagine how many homes there are in the suburbs going out. It goes out for miles, like New York City. It goes out for miles and miles, thousands and thousands and thousands of pounds and thousands of homes, each valued in millions of dollars each. We're talking billions, billions and billions of dollars. We're talking hundreds of billions. We're talking humongous amounts of money here, right? Now, for years and years, these banks in the Canadian banking system have been making record-breaking profits. You want to know why? Because they've assessed the value of these homes as being worth like say a guy's got a shack. He's basically got a shack. They say, okay, your shack is worth $1 million. Okay? Now, we're going to give you a home equity loan for 500, a credit line for 500,000. Or whatever. So these people that got these homes, lucky enough to have these homes, not here in Nova Scotia, but in Ontario, these homes are worth these record amounts of money, and other places in Canada, like Vancouver and places like that. Okay, so they've been borrowing on what these homes are worth. Like they'll give them a credit line of like $500,000. Here, go out and have fun. And so they've been going out and spending this money based on the value of what their home is supposedly worth. Well, this whole thing with the real estate market has crested. And Canadian personal debt has crested at the same time. And Canadian money that they've loaned on these homes and everything else has crested at the same time. Now, the banks have a money creation tool. They can just basically, the guy goes in, he says, my house is worth $1 million. They say, yes, Mr. Jones, your house is worth $1 million. We're going to give you this $500,000 line of credit, etc. As soon as the bank gives them that money and they start spending it, then the bank is actually creating that money into the system. Okay? And this creates inflation because the people are going out and spending this money and everything. They're having a great time. Wonderful time up here in Canada. Buying everything. Buying, and there's a lot of inflation, and there's a lot of movement of money up here in Canada, and the economy's going along good. And all of a sudden, what happens when the real estate market stalls? Nobody's buying houses, which is right now, what's happening? Nobody's buying homes, and the price of these homes start to fall. And I mean fall, crash, because they're so overvalued. The prices of them could get cut in half. So all of a sudden, these guys that have borrowed all these money for all of these years, suddenly there's no jobs up here anymore. Suddenly the economy's going down the tubes up here. And what's happening is these guys who have spent all this money suddenly can't pay it back to the bank. It's just impossible. Now, the banks have a creation tool where they created this money. In one hand, it's easy to lend it out, but now the bank has that on their book. They created that loan to the guy, and they've put it on their book. It says, Mr. Jones owes us $500,000, and this is a credit to the bank, and he's going to pay it back with interest and everything else. And that's on the bank's book as being capital for their bank and capital funding for their bank and for their banking system. Suddenly, Mr. Jones can't pay them back. And when that becomes credible, the fact that he is never going to pay that back, and he's just went into receivership, and he's filed for Chapter 11 bankruptcy, now the bank has to reluctantly go in and has to write that down as a non-performing loan. The bank has to make good for that money. Now, how does the bank make good for that money? Well, the answer is the bank's money creation tool only works in one direction, lending money out. They cannot actually create the money to pay off that loan that they gave the guy. Once they created that loan, now the bank has to make good for it because he's not paying. And they don't have a money creation tool to actually create the money to settle that. Suddenly, the bank has non-performing loans. The bank actually is on the hook for all of that money. Now they're in trouble. The bank is in trouble. This is what happened in Italy. This is what could come over to Canada. So now what do they do about that? Well, there's two ways to fix the banks that way. The government can either bail them out with fresh money and go deeper into debt. That's one way to bail them out. Or to bail the banks in by stealing the creditors' money. That's the people who have bank accounts like you and me and everybody else. To steal our money is called a bail-in. So those are the only two methods the bank can get out of trouble. Either that or go bankrupt, right? So now, if this real estate market here in Canada completely pops, and it sure does look like that's what's coming, and it's not going to take much of a push. If Trump wants to give us a push, it's not going to take much of a push to get this thing rolling down the hill. You know? And when this whole real estate bubble up here in Canada pops, we're talking billions and billions of dollars in this banking system. With all these banks suddenly here in Canada would be going belly up, belly up. But how does this affect the United States? Well, here's how. Take a look at this article. The rise of Canadian banks in the United States. In 2008, during the financial crisis, it changed the landscape of the financial world. Cornerstone institutions like Merrill Lynch and Lehman Brothers were either paired up with commercial banks to maintain solvency or simply defaulted, leaving shareholders and clients like to absorb most of the consequences. Even the banks who weathered the storm well followed the collapse of the U.S. housing prices, and the default of many mortgage borrowers wiped out the value of an entire market of collateralized debt obligations, CDOs. The widespread impact of the event earned it the name the global financial crisis. It says, however, the global 2008 crash may have been, though, its impact was felt relatively little in Canada. Canadian banks, characterized by low-risk tactics and high levels of federal oversight, the Canadian financial sector has thrived since 2010. Now, I'm going to tell you why they thrived. Because they've made all these loans out on these overinflated real estate prices up here. That's why they've thrived. It says, when the dust finally settled and began to settle after the housing bubble popped, the strength of the largest Canadian banks, particularly Royal Bank of Canada, Bank of Montreal, and Toronto Dominion Bank, have allowed them to aggressively expand their operations south of the border. RBC, Royal Bank of Canada, is now a real contender in the U.S. investment banking activities, currently collecting 3.5% of all U.S. investment banking fees. So you see what's happened? These banks up here in Canada, who are now extended themselves out to the Canadian real estate market for billions and trillions, I'm not going to say trillions, but perhaps even trillions of dollars, they've extended themselves out, have now branched out into the United States, into the United States banking system, and they've integrated themselves almost like the way a plant will spread its roots out. Its tap roots out into soil where you can't see the roots have went. So up here in Canada, these banks have spread their roots down into the United States. And they've integrated themselves into the American banking system. So if the Canadian banking system goes down entirely, and these big banks up here in Canada, like BMO, TD Dominion, RBC, and all these big banks go down, they're going to carry the American banks down with them, because the American banks are just barely keeping their head above solvency to begin with. You know? And so this is the problem I wanted to bring out to you guys this morning and show you in this episode. How I mean, amazing things might start to happen in the next couple of years. We might be going through some really rough times, seriously. And I'm going to tell you, the Canadian real estate bubble is popping. It's popping really fast. It's starting to pop right now. And it's going to be a total wipeout disaster for Canada. Canada could turn into a Venezuela, seriously. And it wouldn't take much. So Donald, to put us there. So I know it's going to go anyway, but if you give us a push, we might go down the hill a lot quicker and fall into the abyss an awful lot quicker than if you don't push us. You know, because we're teetering on the bluff right now up here in Canada. This is not a good situation. So listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye.